Hello everyone. In this video I'm going to continue my discussion about the three different methods of inventory costing, and we're going to compare FIFO, LIFO, and the weighted average. So a different cost flow is assumed for the FIFO, LIFO, and the weighted average inventory cost flow methods. As a result, the three methods normally yield different amounts for the following. First of all, the cost of goods sold, the gross profit, the net income, and finally ending inventory. We'll find that cost of goods sold and gross profit, they always work opposite to each other, because if my cost of goods sold is high, the gross profit would be low. And if the cost of goods sold is low, then the gross profit would be high. Gross profit and net income, they work in the same direction. So if gross profit is high, then net income would also be high. And if gross profit is low, then net income would be low. So note that if costs or prices remain the same, all three methods would give us the same results. However, costs normally do change. It's hard to find a company that's buying all its items or all its inventory at the same prices. Usually there's some kind of fluctuation in prices. So using the example that we had for the perpetual inventory system, where we had sales of 39,000, remember the selling price was $30 and we had 1,300 units that we sold. The difference in cost of goods sold, gross profit, and ending inventory would be shown below here. So you can see that for sales, we have a fixed value, whether we're using FIFO, weighted average, or LIFO. It's always the same, 39,000. The cost of goods sold, based on the schedules that we created before, varied. So we had first in, first out, or FIFO, gave us the lowest cost of goods sold. It was 26,720. The weighted average was something in the middle, which is 26,900. And the last in, first out, or LIFO, gave us the highest cost of goods sold. When cost of goods sold was low, we got a high gross profit. It was 12,280. And then the weighted average had a slightly lower gross profit. And then last in, first out, we had the lowest gross profit. So this is why, if you think about public companies, they always want to show that they have better profit. Many of them, they like to use FIFO to value their inventory, because when they use FIFO, they would get a gross profit under the assumption that prices are going up. If I'm a company that cares too much about avoiding taxes, then I would like to show lower profit, and if this is my intention, then I would use the last in, first out, because as you can see here, the gross profit would be the lowest. So if you look at inventory, which is the ending value or the ending balance of inventory, it's 18,460 was the highest when the gross profit was high, and also for LIFO was the lowest when gross profit was low. So this is just something to give us an indication or a comparison between the three different methods and how the values would be the same. So now let's see the effects of changing costs, FIFO, LIFO, cost methods. So we're comparing FIFO to LIFO. And by the way, the weighted average would be always something in the middle. So as I said before, cost of goods sold, in the cases of increasing prices, which is normally the case, LIFO would give us the highest cost of goods sold. Gross profit FIFO would give us the highest gross profit. Net income would give us the highest, like FIFO would give us the highest net income, and for ending inventory, FIFO will give us the highest ending inventory. And of course, it would be the opposite in terms of lowest amounts. If prices are going down, then the highest amount would be FIFO for cost of goods sold, and LIFO would give us always the highest amount for gross profit, net income, and ending inventory. And the opposite, of course, is true if we're considering the lowest amount. So now if we want to compare inventory costing methods, FIFO reports higher gross profit and net income than the LIFO method when cost prices are increasing. However, in periods of rapidly rising cost, the inventory that is sold must be replaced at increasingly higher cost. In such cases, the larger FIFO gross profit and net income are sometimes called inventory profits or illusory profits. These are not really real profits, it's just profit because of the difference in the methods applied. So during a period of increasing cost, LIFO matches more recent cost against sales on the income statement. So LIFO also offers an income tax savings during periods of increasing cost. So companies who care about taxes would or care about avoiding paying taxes would use the LIFO method. So this is because LIFO reports the lowest amount of gross profit and therefore lower taxable net income. However, under LIFO, the ending inventory on the balance sheet may be quite different from its current replacement cost, and that's another problem. So the weighted average cost method, as I said before, it's a compromise between FIFO and LIFO. It's always something in the middle. The effect of cost or the price trends is averaged in determining the cost of goods sold and the ending inventory. Now let's talk about reporting inventory in the financial statements. So cost is the primary basis for valuing and reporting inventories in the financial statements. However, inventory may be valued at another than cost in the following cases. So what are these two cases? One of those cases is the cost of replacing item in inventory is below the recorded cost. So in other words, the value of those items in the market are now below what we originally paid for. The other case is if the inventory cannot be sold at normal prices due to imperfections, style changes, spoilage, damage, obsolescence, or any kind of other causes. So let's see evaluation of what we call it LCM, or lower of cost or market. I know LCM has a different meaning in math, which is the least common multiplier. In accounting, we have a different meaning for LCM, which is lower of cost or market. So if the market is lower than the purchase cost, the LCM, or the lower cost of market method, it is used to value the inventory. Market, as used in lower of cost or market, is the net realizable value. So when we say market, we are referring to something called net realizable value of the inventory. And how do we determine the net realizable value? It's basically the estimated selling price minus any kind of direct cost of disposal. So direct cost of disposal includes selling expenses such as special advertising or sales commissions. So let's see this example. Assume the following data about an item of damaged inventory. The original cost was $1,000. The estimated selling price was $800. Estimated selling expenses is $150. So you can see that the original cost was $1,000. The estimated selling price went down to $800. So in applying LCM, the market value of the inventory is $650, which is computed as follows. You see here the market value, or the net realizable value, is equal to the selling price minus all the selling expenses, and what we got is $650, 800 minus 150. So therefore the inventory would be valued at $650. So we call that the net realizable value, or the market value, which is the lower of its cost of $1,000 and its market value of $650. So when we compare the original cost to the market value, we go with the lower, which is the market value, or the net realizable value. So in this case, we have to reduce our inventory item from $1,000 to $650. So the lower of cost or market method can be applied in one of three ways. The cost, market price, and any declines should be determined for the following: each item in the inventory, each major class or chain or category of inventory, or total inventory as a whole. So let's see an example to apply that. So see here we have like 5 items that we have in our inventory: Echo, Foxtrot, Sierra, Tango. It's actually 4 items, and we have their total. And then we have the inventory quantity and the cost per unit. And then we have also the market value per unit, or what we call the net realizable value. So what we're going to do is that we're going to calculate the cost and the market. So the cost would be based on the inventory items, or the inventory quantity, multiplied by the cost per unit. So we took the 400 multiplied by $10.25, and that would be $4,100. And we do the same thing for Foxtrot, 120 multiplied by $22.50, and that would be $2,700, and so on. Then we do the math for the calculation for the market value using the same approach, where we get the inventory quantity and we multiply it by the market value per unit, or the net realizable value. And then we do the math here. And then we add the total, and we compare these two values. Which one is lower, cost or market? So as you can see here, the market is lower. So we're going to reduce our inventory using the difference. The approach I just did here is using total inventory as a whole. which is one of the extreme methods. Like I get the total for the cost, total for the market, and then we get the difference. You can see that the market is lower, so we go with the market and we reduce our inventory by the difference. Another approach is that we go item by item and we compare cost and market. So here we can see that the market is lower, so we record the market under LCM. Then we compare cost and market and we keep it at cost. Compare cost and market and we take the market. Cost and market and then we take the cost. And then we add this column and we get a new total. We compare this total, the 15,070, to the 15,520, and the difference would be the amount of reduction in inventory. This approach is based on each item in the inventory. Another approach, which is each major class or category of inventory. Let's say that Echo and Foxtrot with one category, Sierra and Tango were another category. So what we do is that we get their total for cost and total for market, and we compare this category of Echo and Foxtrot together, and we record their LCM total, and then we do the same thing for Sierra and Tango. We add these two values and these two values, and we get the lower of these and record them at LCM, and then we get the two major total values here, and that would be our LCM value. Again, this would be a categorical kind of application of LCM, and we call that each major class or category of inventory. So at this stage, I really want you to know the two extremes, which is going item by item or going with the totals as I just did at the very beginning. So there is a checkup corner here. I'll leave that for you to apply yourself, and in our next video we're going to be talking about inventory on the balance sheet and how we present it on the balance sheet.